When will people realize that you're going to have a breakout of tremendous proportions and go ahead of it? Or do they have to see the real breakout before they realize, holy cow, why didn't I buy that stock?
SoFi just released second quarter earnings results numbers on Tuesday, smashing everybody's expectations from revenue and from the net income line, marking the third consecutive quarter of profitability for the business, obliterating every expectation out there, issuing spectacular guidance, and the earnings call was perhaps the peak of SoFi management. And yet, despite all of this, the stock actually traded down on Tuesday. And so in this video, I'm going to be doing a full earnings breakdown of what happened in SoFi's earnings, what did they report, what happened on the call, and breaking it all down by segment for you. It's going to be a big video, so let's jump right in. So as usual, we're going to break this video down into sections, starting with lending, financial services, tech platform, guidance, financials, analyst insights, and obviously the earnings call. If you're interested in staying updated on SoFi, be sure to subscribe for more content. So let's first start off with an overview. Let's just cover the high-level numbers relative to analyst expectations, because what we do know about SoFi is that this business has a very rich history of crushing analyst expectations. This quarter was no different from that. The business reported GAAP revenue of $598 million relative to the $564 million forecasted by analysts. And even when we did the SoFi Weekly podcast, our own forecasts, which are more bullish than analysts, didn't even come close to this number. My forecast was the most bullish one throughout that episode, and even I only forecasted 588 million. And so to crush it would have been an understatement for the business. So they beat analyst expectations by $35 million or so. And in terms of the bottom line, many analysts here expected 0 cents EPS for the business. I even posted the earnings whisper photo before the earnings, which highlighted 0 cents as the forecast. Although investing.com in this chart is giving me 1 cent EPS as the expectation, which of course they came in line with 1 cent EPS, which equated to 17 million in net income for Q2. Now, keep in mind, the reason why I say they beat on the bottom line, despite what investing.com is saying, is because management had forecast between 5 and 10 million in the bottom line, and they came in at 17 million, almost double the top of the range. In addition, they also raised their guidance, and I'm going to talk about this a little bit later on. But in my opinion, the raise of the guidance was one of the most bullish indicators for this earnings. So we're going to get into that. Now, let's start off with members and products and then move our way down into the individual segments. This quarter, for example, SoFi saw new member additions of 643,000, bringing the total member count to nearly 8.8 million members, up 41% year over year. Of course, on SoFi Weekly, our predictions were fairly close, falling between my prediction and Chris Hager's. I predicted 650. Chris Hager predicted 640, and they came in at 643. And this now marks the third quarter in a row where we see an acceleration of new members on an aggregate number basis. And if we exclude the outlier quarter, which was Q3 2023, the Taylor Swift quarter, that trend has been steadily climbing since Q1 of 2023. However, the thing to note here is that Q3 is coming up again, and that's going to be a very tough comparable quarter for SoFi, since to date, that is the single highest quarter of member additions. So we're going to see how they do in the next quarter for member additions, relatively speaking. And one thing I did mention last quarter is that I don't think we'll ever see a 5 handle again on SoFi's new member additions. And this new member addition for Q2 makes me all the more confident that that prediction will hold true. I think that Q3 is going to be a new record for SoFi as we step towards the 800,000 to 1 million new member prediction that Anthony Noto himself has made in previous interviews. Now, in terms of products, we know that this goes fairly hand in hand with members. For Q2, SoFi added 946,000 new products, bringing the total to nearly 12.8 million products, up 36% year over year. In terms of our predictions, we came in fairly close with products as well. Mine was the closest, 952,000 new products relative to the 946,000 they actually reported. So just about 6,000 products off for the quarter. In addition, SoFi seems to be stabilizing in terms of the product member ratio, which has been falling steadily since Q1 of 2023 and came in quite flat for Q2. But all this, in spite of adding so many more members, it's a good sign to see the members to products ratio stabilize, because it speaks towards the cross-selling capabilities for the business of members basically trying new SoFi products. Now, I'll skip the Galileo accounts for now, and I'll cover them while talking about the tech platform in general, and I'll jump straight into the product breakdowns by segment. So like we mentioned, total products grew 36%, and this breaks out into 2 categories: lending, which features student loans, personal loans, and home loans, and financial services, which has SoFi Money, checking and savings, SoFi Invest, credit cards, Relay, and others. This quarter, the lending segment grew 19% year over year to 1.78 million total lending products. Of course, we're seeing a gradual decline in the year-over-year growth percentage. As we know, the lending segment is not the main growth driver in this macroeconomic environment. In terms of the financial services products, here they grew 39% year over year to 11 million financial services products. Interestingly, here, when we look at the footnote, it highlights that product growth was 47% when excluding digital assets related to the transfer of crypto services in 2023. So the growth rate in financial services has been very strong, and I think it's going to be continuing to be strong just given the guidance. Now, I know we've been talking about this in the past, but I want to mention it in this video because we're seeing the revenue mix shift before our eyes. Lending was the historical SoFi business, and financial services is the fast growing new segment for SoFi, which will carry them into a new era, essentially, of what that business does. Currently, 45% of revenue comes from non lending segments, basically financial services and the technology platform. And the goal of this is to be 50-50 between lending and non lending by the end of the year. All of this contributes to the financial services productivity loop, which essentially measures the ratio between financial services to lending products. And this ratio increases every year because financial services is growing much faster. As of Q2 2024, we have over 6x more financial services products than lending products. And one of the main reasons for this is the lower barriers to entry for financial services products relative to lending. And this low barriers to entry of financial services leads to more cross-buying. Because it's very easy for me to onboard onto Relay or SoFi Invest or SoFi Money, I'm going to try more products. And overall, I'm going to play a bigger part in that ecosystem. Now, one thing that it leads to also is a perception shift in this business. In a world where lending is the majority of revenue, it's very fair for analysts to call this a lending company. But when that revenue mix changes, the perception of SoFi's business is also going to change. Here's Anthony Noto talking about it in the CNBC interview.
All right, do you think, Anthony, that there's the possibility that people still remember the heritage, which is student loans, and they say, as President Biden forgives student loans, I can't own SoFi stock?
I do think there's a legacy of us being predominantly a lender. On the earnings call, as a matter of fact, we had analysts ask questions. 99% of them were about lending. There was only one question about the financial services segment and a question of whether we could sustain the 80% growth or not. And I talked through product growth of 40% and revenue per product growth of mid-20s to 30%, which there's still a lot of upside in both of them. And their focus continues to be on the thing that we used to be as opposed to the thing that we've become. And we're trying to emphasize the magnitude of the innovation we're driving. We've rolled out alternative assets, which helped us drive 58% growth in AUM and brokerage. In addition to that, we're providing auto, home, and life insurance. Our credit card business is starting to make a turn. And so we're seeing really strong trends outside of the traditional lending business. And it's going to take a while for people to accept that that's the driver of growth going through the rest of the year.
Now let's dive into the specific segments of SoFi's business, starting off with the largest revenue contributor, which is still lending. Let's stick with the products before we go into the financials and drill one layer deeper into this chart, splitting the lending segment out by the individual business streams. So of those 1.78 million total lending products, we can see the majority of growth was in personal loans category, which grew 24% year over year. Student loans grew 8% year over year. Home loans, which is drastically smaller than the other two segments, grew 19% year over year. Looking now at the lending segment operations, we can see that revenue for lending came in at 340 million, basically flat year over year. And the reason why it was flat is because net interest income saw a 20% growth, but this was offset by a 38% decline in non-interest income. And I know I've explained the difference between these two in previous breakdowns, but just to refresh everybody's memory, net interest income is the money that banks make from loaning out money. So mortgages, personal loans, so on and so forth, minus what they pay to people who deposit money in the bank. So it's basically like profit that they make from the interest on loans. Non-interest income, by contrast, is all the other ways that banks make money. So basically the fees that you pay from services like account fees, transaction fees, money that they make from trading, income from services like investment advice or insurance, basically any money that they earn that is not from lending. So it's generally good that net interest income is rising because these are the main functions of the lending segment. And this little 3% year over year increase was partially the reason why this was a great earnings report, because last quarter, the lending segment was down 1%. So lending is seeming stronger than the company had initially guided for at the beginning of the year. And this is positive because it shows strength in the biggest revenue segment for SoFi. SoFi's highlighted that this rise in net interest income was as a result of higher loan balances and yields. Contribution profit was up 8% year over year to 198 million. And one thing I will continue to note in every single earnings report is that directly attributable expenses, while rising, are rising at a slower pace than what the revenue is rising at. In terms of originations in the lending segment, this was up 22% year over year, driven predominantly by a massive 86% increase in student loan originations. Personal loans, their biggest lending line item, reached a record 4.2 billion in originations, up 12% year over year and 28% quarter over quarter. Home loans saw a 71% increase in originations. And just keep in mind that the highest percentages in originations are going towards student and home loans, both of which are going to see massive tailwinds throughout the end of the year as rates are expected to fall. And one thing to note here is that when SoFi reported their first quarter earnings results, home loans and student loans were rising, but personal loans were flat. And one thing I mentioned in that breakdown was that with personal loans being flat throughout the year, it's going to be easier for the business to achieve a 50-50 split between lending and non-lending because lending is essentially not growing. However, if we're still seeing personal loans in this quarter increase, as well as the revenue for lending and profit for lending also increase, this just means that the growth for the non-lending segments has to be even higher in order to achieve that same 50-50 split. Now, with that said, let's move on to the technology platform. I mentioned while covering the earnings live that this segment was perhaps the biggest disappointment in earnings. And if this segment was a little stronger, I think it would have been a 10 out of 10 earnings in my mind. With that said, since SoFi has such conservative guidance, it was not as though the technology platform missed. They just didn't have as strong guidance as I would have hoped for them to have. Let's start off with accounts. So the tech platform essentially saw a 7 million increase in accounts this quarter, bringing the total accounts to 158 million. This represents a 23% year over year increase. Now, you could argue that we're really seeing an acceleration in the growth of Galileo, but they're also coming off a really weak comparable period. And the reason for this is because they had a dip in accounts in early 2023 when they lost Current. And so when you look year over year, the numbers look stronger because you're going off of a lower base. Revenue for the technology segment came in at 95.4 million in Q2, up 9% year over year. I know we had hoped that revenue for the tech segment would be over 100 million. And that's not really quite what we saw. Now, one of the positives here is that the directly attributable expenses actually went down 9% year over year, which is great, right? Because you have revenue going up and then you have expenses going down. The operating leverage for that business is amazing. And ultimately, that's just going to lead to higher profits, right? Contribution profit for Q2 came in at 31.2 million, an 82% increase year over year. The technology segment margins were 33%. So there's a lot to love in the technology segment. It's just the growth rate was not as strong in the revenue, and the guidance for growth is not as strong as they had previously thought it would be. Now, the press release that they issued mentioned that the growth in the tech platform was driven by the performance of new clients coming on board over the last 4 quarters and monetization of existing clients on the platform. And I think this is an important point that most people will completely skim over. But what I've mentioned in the past is that the technology platform is unique because it's the only B2B segment in SoFi's business, which comes with an entirely different dynamic and expectations of how growth is achieved in that business, right? In the B2B side, there are sales cycles, there's software spending budgets, there's seasonality, there's proof of concepts, there's very long timelines, there's an entire deal pipeline essentially of getting deals done. So it's not really as easy as increasing spend on sales and marketing, and all of a sudden it's going to lead to more users. Galileo has been releasing products on a very steady pace, and that's very encouraging to see. But one other thing I mentioned in the live stream was that if I were to break out all 3 of SoFi's businesses on a timeline and mark them in terms of most to least important, I would say that the most important, shortest timeline would be lending because of the macro environment and rates coming down. In the middle timeline would be financial services because it's growing 80% year over year, and it's actually going to be contributing to SoFi's perception shift of being a more diverse business with a stronger moat. And the long tail is the technology platform of SoFi becoming this AWS of fintech. So if the technology platform lowers guidance for a couple of quarters today, I don't see that as the end of the world, right? I would see it as a much bigger threat if lending segment was down or if financial services was down, because we have higher expectations on those other segments in the short term, and technology platform is really a long-term play for SoFi. Now, it's obviously not great to see either way, but I would have rather had this than weakness in the other 2 segments. And that's exactly what we're seeing. And the other thing to note is that the technology segment is their smallest of the 3 business segments from a revenue perspective, as financial services is just explosive in its growth. Speaking of, let's now move into financial services, their fastest growing segment. let's keep with that same theme and do a product breakdown for this segment as well. So if we go back to that initial chart, which highlighted total products, we can dive one level deeper to see where these products came from. So we had about 11 million financial services products, and we can see the majority of them came from SoFi Money. SoFi Money grew 60% year over year to close off Q2 with 4.3 million products. And remember, SoFi Money also includes the checking and savings account held at SoFi Bank and cash management accounts as well. They also offer 4.6% APY, which management assured us on the call that they would maintain even as rates start to fall. They would maintain the highest APY in the market as a result of their vertical integration and their competitive advantage. The second biggest financial services product is Relay. This has 3.9 million products, and this was also up 54% year over year. SoFi Invest has remained flat year over year at 2.3 million products. And after the increases in credit cards, referred loans, and SoFi at Work, the total financial services products, as we mentioned, are up 39% year over year. So obviously that's amazing from a product perspective in the financial services segment. And looking at the financials, we can see an 87% growth in net interest income and a 58% year over year growth in non-interest income for financial services, bringing the total net revenue growth of 80% year over year. And the most beautiful part of all of this, in my eyes, is the directly attributable expenses only increased 18%, while the total net revenue increased 80%. Financial services profit came in at 55 million compared to a contribution loss of 4.3 million in Q2 of last year. Management highlighted these results are a testament to scaling new businesses from an investment phase all the way to profitability through successful unit economics, member acquisition, and cross-buying. And here, it's worth noting that all three business segments saw higher percentages of revenue relative to their attributable expenses. They have operating leverage in all of their businesses. Their revenue is growing faster than their expenses are growing. And this is because the business is making more money while keeping their expenses relatively small. In the end, this translates to more profit for these individual segments. And that wraps up all three segments. I'm just going to talk a little bit about the financials and then go into the guidance. So net revenue, as we said, 597 million, 22% year over year growth. EBITDA, 138 million, 23% margin on this. Now, my forecast was very close on the EBITDA. I said 140 million for EBITDA, and they actually came in at 138. So incredibly close there. Before I talk a little bit about my general thoughts, I want to also talk about the guidance and outlook they provided, because I thought this was one of the most bullish aspects of the entire earnings report. Keep in mind that Q1, the stock fell simply due to weak guidance for Q2, and it led to a lot of fear for us going into this quarter. And they ended up smashing these Q2 numbers, but the guidance they provided for Q3 and also the full year guidance was mind-boggling. So for Q3, the business expected to deliver between 625 to 645 million in revenue, which would be a record by a large amount. This would be a massive spike from what we've seen so far. They expected 160 to 165 million in EBITDA and 40 to 45 billion in net income, which results in 4 cents EPS. And I posted on X that this guidance is simply going to force every single analyst out there to have upward revisions in their expectations. Simply the reason why is because most analysts have SoFi to deliver between 6 cents and 7 cents EPS for the full year. And if we do the math, they did 2 cents in Q1, the expectation was 0. They did 1 cent in Q2, the expectation was 0. They're forecasting 4 cents in Q3, and all of a sudden you have 7 cents right there if they even meet their own conservative guidance. But like I said, if they come in at something like 6 cents for Q3, for example, they're crushing analysts' full year expectations in only 3 quarters. So every single analyst out there has to be doing the same mental math that I'm doing. And whether they like it or not, they're going to be forced into an upward revision for the business. So let's switch over now to full year guidance. For the full year, they expect financial services to grow more than 80% year over year, lending to be at least 95% of last year, and tech platform to grow in the mid to high teens versus the previous year. If we compare this to the previous guidance that they provided, the financial services aspect was to grow over 75%, and they revised that upwards to say a minimum of 80%. The lending segment was between 92 and 95% of last year. Now they're saying minimum 95%. And I mean, even back in January, I was saying there's no way they're doing 92% of last year. They're going to be flat, if not single digit positive. I still hold to that. I still think they're going to raise this even now. And the negative here is that tech platform, they had it growing in the 20% range, and now they revised that downwards to the high teens. And one thing to consider is that here the stock fell so heavily due to the decline in the lending segment, right? So if they increase the expectations on the lending segment, and basically if the lending segment does better than expected, there's no reason for the stock to have seen such a massive decline. And all of this equates to 9 cents and 10 cents of GAAP diluted EPS for the full year. That's what they expect. I think they're going to come in much higher than this. I think between 12 and 15 is something realistic. They also expect a 50-50 revenue split between lending and non-lending segments combined. And here in the slide, we can see the columns with the original guidance, which called for 14 to 16% increase in the growth rate. This was revised upwards last quarter to 15 to 17%. And as of Tuesday, this was once again revised to 17 to 19% growth. Now, why am I so confident that they're going to get further revised upwards? Well, simply put, on their earnings call and subsequent interviews, management has reiterated they're being conservative by design. And the reason why is so that they can account for anything that may happen in the macro. Anthony Noto even said that unemployment numbers was something that he was looking closely at and that they can adjust their strategy accordingly. Meaning that if we have a soft landing or a better than expected macro economy, the business has it within their purview to ramp up the growth rate in lending and to be more aggressive, to capture more market share, which means that management's expectations and guidance has some pretty negative macro backdrop. And I think as the macro turns out to be better than expected, it'll give the company more confidence to take more risks and to amplify their growth rate further. And I think this will catch all the analysts completely off guard because they're discounting management's already very conservative guidance. The other interesting thing here to note is with regards to the financial services guidance, they provided no upper threshold. That segment put up 86% year-over-year growth last quarter. It put up 80% year-over-year growth this quarter. And all management is doing is saying we're going to do a minimum of 80% going forward. But the actual results can even come in higher than this. On the call, for example, they mentioned that financial services drove 91% of product ads in the quarter. Alternative assets contributed 12% of the net flows in quarter, and that delinquencies peaked in March. Let me say that again. Delinquencies peaked in March. That trend has been coming down slowly. That's massively beneficial for the business. And something we haven't even talked about is that they introduced new product offerings, right? This was a prediction that I made on the SoFi Weekly that surprisingly also came out to be true. On the earnings call, they talked about 2 new credit cards, which they plan on introducing a little bit later on in the year, as well as a subscription service for SoFi Plus members. The subscription service, of course, is something that people immediately were going to start to compare to Robinhood Gold. One thing Anthony Noto highlighted on the earnings call was the opportunity potential for the credit card business as a whole, saying that they're new and they're ramping up credit cards, but currently that business alone has the potential to be bigger than SoFi's entire businesses today. And this speaks to how big of a potential credit cards can potentially be and why management is continuing to invest in credit cards, even though they are a very small portion of financial services today. There's a lot of things to pick up from the earnings call that management highlighted. The major thing was the tone of the call. It was the best earnings call that I think I've ever heard from management. They sounded confident. They were assured in their numbers. They sounded optimistic about the future. I even posted Anthony Noto's closing remarks on X.
Q2 was the most rewarding quarter, and dare I say, the most fun that I've had in some time at SoFi. We challenged ourselves to be better in areas that aren't supposed to do well in this environment. The team found a way to be better continuously throughout the entire quarter, not just each month or each week, literally each day. Finishing strong all the way through the tape when, quite frankly, the only reason was because we pushed ourselves to keep iterating. If you can't tell by now, I feel great. To put it bluntly, I do not know of any financial services company or fintech that has transformed their business to be less risky, less capital intensive, while still driving strong revenue growth, 40+% user growth, all while massively increasing profitability and still funding a rapid pace of innovation. I love what we have built, but more than ever, I love the people we are building it with and the gritty culture we have created. Hard is not for everyone, but for me and those who stay at SoFi, it fits just fine.
Oh my gosh.
Honestly, a mic drop moment.
He's talking in all caps, man. That was so much fun.
Of course, there's things that I didn't really cover in this video, like the life of loan losses, the unpaid principal, which they all highlighted as additional slides. I think overall, it's good that they're publishing more information and additional data for this because this is something that analysts are looking very closely into. And I think this is going to bode well for analysts to have a better understanding of the business as a whole. Of course, following the earnings call, we had some public appearances from Anthony Noto to talk about the results, as well as analysts updating price targets, which we've been seeing over the past couple of days, which of course we're going to cover in more in depth in future videos and also on the SoFi Weekly podcast when we break this earnings down even further. Overall, I think this earnings was one of the best that I've seen from SoFi's business. it makes me excited to go into Q3 because in my mind, Q2 was really the biggest hurdle. And now that we're on the other side of it, Q3 and Q4, I think are going to be smooth sailing. And they smashed every single expectation in Q2. And so that makes me even more bullish going into the next quarter. I hope you enjoyed this earnings breakdown. It takes a long time for me to prepare these videos. And if you did enjoy it, subscribe to the channel and also share this video for more. Thanks so much for watching. I will see you in the next one.